Good morning, Fiat. Just kidding. Hey, Knoxville. Jerry, I figured you'd like that one. That's a good way to start it off here, guys. This is the Organized Investor Show, brought to you by Tennessee Wealth Management. 4 of us in the studio, and our goal is to help you organize 3 things: your investments, your retirement, and your affairs. Thanks to my beautiful wife, Susan, part of the team here. You can think of us as, this is her coined phrase, East Tennessee's Financial Four, your financial forecast on the Organized Investor Show. It's me, yapping. I'm Ainge. You can hear me on the Sports Animal, 9 to noon, Monday through Friday. I'll quarterback this team we got right here, this Tennessee Wealth Management team. And let's start right here with Megan Hubbard, master's degree in curriculum and instruction and former first grade teacher at CAK. Susan Ainge, my beautiful wife, part of the team and here to balance out the guy-girl ratio and keep us in line here. Now Megan's not outnumbered. And Jerry Goodman, Megan's dad. CFP, guys, for 43 years. He's got so much experience. He was a vice president at Merrill Lynch. He's forgotten more about this stuff than a lot of us will ever know. And thank you again for showing up and listening. And thanks for showing up. Hopefully we don't have any personal fouls between us. 15-yard penalty, maybe an automatic first down. Anybody?
Anyway, so something else that's even funny or maybe strange in terms is financial advisors will never tell you what their track record is. They may tell you a lot of things they're planning on doing, what their company's going to do, but they won't tell you what they've actually done. So we're going to run through just how much our clients have been able to get their financial future improved over the last year. So take it away, Dr. Ainge.
I like that. All right, guys. For the first 9 months of 2025, the 210 accounts managed right here by Tennessee Wealth Management. This is through September 30th, 2025. Guys, an average net rate of return of 33.2%, 3.5 times more than the Dow Jones average. Over the past year, 29.8%. Over 3 years, 22.3%. Over 5 years, 18.3%. You're seeing a trend here. That 18.3% is more than 7 points higher than the Dow. That 18.3% number is more than double what would have happened in a mutual fund portfolio. And over 7 years, 17.1% annually. Again, crushing the Dow Jones by over 7 points.
Just remember, past performance is no guarantee of future results, and that the returns may vary depending on the asset allocation and tolerance for risk of each account. Also, these are net rates of return after any kind of fee or cost. They are posted on our website, theorganizedinvestor.com, and we invite you to take a look at them. It's a 10-page summary that, again, your advisor will never, ever show you.
Getting returns like this isn't by luck. I don't even believe in luck, but it's by method, I promise. And it's by having a process that works and executing it time and time again. And being able to improve all of these financial lives is by focusing on 3 things. Lower advisory fees, because we are usually about 0.25% less. For $1 million portfolio, that's equivalent to $2,500 a year or $50,000 over a 20-year period. Avoiding internal costs by not using mutual funds, ETFs, and other investments with hidden fees, and better performance by simply being more selective with the investment choices that you make.
You know, Megan, the fact you mentioned luck reminds me of a couple of shows ago. I said something to Eric. I said, Eric, do you realize being superstitious is bad luck? And Eric, you said,
I'm not superstitious, but I am a little stitious.
Isn't that funny? I've actually used that. I'm not even giving him a license.
You're welcome.
Off that. Free royalty things for me. So for those 3 things Megan's talking about, our 2% goal of improvement is like for a $1 million portfolio, that's equivalent to $20,000 a year. 2% of $1 million, $20,000 a year, $400,000, folks, over a 20-year period. It's a chunk of change. And that is in addition to what you're already earning. So we admit we just made up the 2% goal, just pulled it out of the air. But what it shows is even a small little tweak like that to somebody's portfolio can dramatically improve your financial future. It makes a big deal. And sharing the results that we're doing here, it gives you some sort of benchmark to compare it to your situation.
Lower advisory fees and hidden costs, avoiding those hidden costs. Those seem pretty obvious, but how to improve your actual performance, that's a little more involved. First, you guys don't believe in diversification, which comes from owning thousands of stocks when you're invested in 15 to 20 funds. When you own virtually every stock on the planet, you own good companies. You also own the not so good companies. Mathematically, your returns just become mediocre. They're average, and that's going to be from suffering from the performance. And that's not good enough.
The term, well, the new word of the day, sort of.
Instead, we use individual common stocks because there are no hidden internal costs. They're much more transparent, so you actually know what you own, and there's better control over your taxes. And we invest in common stocks in two ways. This first is our core holdings with companies with a long history of raising their dividend. That includes companies like Costco, Walmart, Home Depot, Lowe's, Home Improvement, and even Smucker's Jelly. Some of the companies like Lowe's, for example, they've raised their dividends for over 60 years.
And these types of companies are from the Wells Fargo Diversified Stock Income Plan. That is a mouthful. We refer to that as the DSIP list for short, just for simplification. This list has a 30-year track record of over 12% per year. And there's more information about the DSIP list on our website, theorganizedinvestor.com. And because investors view these types of companies as being well managed, their price holds up better during market downturns. So these dividend growth stocks are our core holdings that we use as our starting point.
Excellent job. And the second approach, we refer to it as bargain opportunities. And this is when basically the market, it overreacts, like something like what happened in COVID back in 2020. Had a little banking crisis 2023. We had the tariff scare here in the spring of 2025. That's when we like to swoop in and buy a lot of really good companies when they're on sale. Now, in the spring of 2025, we made over 12,500 little trades in a single day. That was a fun day, which was one reason why our clients are up 33% for the first 9 months of the year. So we also did this during COVID, did it during the banking crisis, which is the reason our 5-year track record is over 18% a year.
And these types of dividend growth stocks, they're less volatile, which means you can move money from things that have not dropped much in price into areas that have gone down a lot, swooping in. Now, if someone just wants to be invested in that the dividend growth strategy, that's fine. If they want to participate in those bargain opportunities when they occur, you guys are there to help them. But your approach, simple. Don't own every stock. Own the good ones.
There's a lot of reasons we use common stocks and avoid mutual funds, exchange-traded funds, and other things with mediocre performance and hidden fees. There are millions of investors whose advisor has them in a mutual fund advisory account where they're paying a fee. What they get from that is a cookie-cutter portfolio of 15 to 20 funds that effectively owns thousands of companies and may be getting just average returns.
So to use our made-up terms again, we love to make things up. Now, we don't make up our results and things that are actually important, but Dad does love to make up some words here. So these investors are suffering from what we've told you before, diversification, by owning too many stocks. And the result is our new made-up word, diversive performance.
Excellent.
Can I make up some words for next week?
Sure, yeah.
Yeah, let's just
Okay,
start
but did you
making
see
up
how
words.
she pronounced that?
We have a contest.
She nailed it.
$20
And then we
for
can
the
have
best
a
word.
Well, we had to make 'em
spelling
right.
bee on made-up words. So the advisor has basically added another whole layer of management, and the result may be higher costs and mediocre returns. So it's fair to ask, what exactly is the advisor doing to justify that fee?
And that's not even rhetorical, folks. What is the advisor doing to justify that fee? On the investments page, again, where we like to talk about on our website, there is an example of a mutual fund advisory account with a 5-year track record. It's less than 9%. And that's even before any type of an advisory fee has been deducted by the advisor. So as a reference, our 5-year performance is 18%. Think about that. That's double. And at what point does this start to get your attention if you are in one of those types of plans? The fact is, most every large firm in this country has some version of this mutual fund advisory program, which is why we all the time see it on client statements when they send them in for us to look at.
Another reason to avoid advisory accounts invested in mutual funds and ETFs is because of the hidden financial incentives behind them, the why, if you will. On the website is a pay-to-play diagram, and it shows how major investment firms receive payments from product providers. These payments, often called revenue sharing or cost reimbursement, come from internal fund expenses that you're being charged.
In the example on our website we just mentioned, the internal cost of the funds is 0.79% annually. That means $7,900 per year on $1 million portfolio, some of which may flow back to the firms that recommended those funds. Some firms even admit they won't offer certain products unless they're paid to do so. All of this is disclosed to their clients, but that doesn't mean many will even read it.
So let's burn a timeout and remind you that none of this will help you if you don't do anything about it, okay? The really smart listener is the one who is not chronically suspicious, who will take what we're sharing at face value and then have a chat with us to how much of this may actually benefit you. That's pretty blunt, I know, but remember, we're offering to help you organize a number of things, but none of it will benefit you if you choose to discount what we're saying, okay? So here's a novel idea. Pick up the phone, call my dad at 865-VOL-415-2070, or send us an email. Either one is a good first step.
So everyone's heard the term BOGO, which obviously stands for buy one, get one free. So thanks to East Tennessee's Financial Four, you now have yet another opportunity of a new phrase. It's called get one free, get one free, get one free, get one free. In case you weren't counting, there's 4 of those stuck in there. And the 4 of us are basically offering to give you 4 different get one frees for you. And here's what they are. No strings attached. Hit it, Mr. Ainge.
East Tennessee's Financial Forecast. Your Financial Four with 4 free ones. Did I do good? All right. The first one here is to help you organize your investments. And they're offering to give you that Morning Star report on your investments. It's usually over 100 pages. And they're going to give you the clear, plain English explanation of what it means, right? Like understanding your investment for dummies.
Yes.
Kind of like you guys, because that's what I need. Not you, the listener. That's me. You'll realize just how much you might save on advisory fees and mutual fund costs and how much we may improve performance and long-term financial future. And again, you can see it all right there on the website on the investments page.
All right, so the second is for someone needing help organizing their retirement. We'll prepare a retirement cash flow analysis. How exciting does that sound? Maybe you could give these out for Christmas.
I can't stand it.
And there's a sample on the retirement page of our website. Oh, it's a different page. We're off the investments page.
Yep.
We're over to the retirement page.
TheOrganizedInvestor.com. Ding.
The retirement page was feeling lonely.
It was. Third, for anyone who's been procrastinating, we can help you get your estate planning documents in place through our partnership with an online company called Trust and Will. For someone using a will package of documents, this will be completely free of charge. Now, if you prefer a revocable living trust, your only cost is going to be retitling your property into that name of the trust. Either way, we'll help you to finally get your affairs in order at little, if any, cost.
And fourth is to help you expand your Tennessee football collection. We will give you a full-size Tennessee football signed by my husband,
That's me,
Erik Ainge, complete with a stand so it doesn't roll off your shelf and clip the cat. Those are the 4 get one frees. No cost, no obligation, no catch. To get the football rolling, so to speak, we need to get a conversation rolling.
And here's a baby step idea, though, guys. Just call Jerry. Ask him anything in 20 minutes. The chat will probably be longer than 20 minutes, but that's okay. He'll save you some time if you really need it. But I'm telling you, just call him. VOL 415-2070.
Finally.
865-415-2070. Go straight to his phone. You can mess with him. But I suggest you pick his brain on all the stuff we're talking about.
And in case some of you that are trying to send Erik his gift for whatever he's done, Erik is Erik with an E-R-I-K, not a...
It means leader in Viking, by the way. Did you know that?
I had no idea. Thanks. So we don't have time to explain what organizing your retirement means to everybody on the planet, but we can tell you what it meant to Sally. Sally is a former postal worker. Back in 2015, a few years back, Sally was 60 years old, working part-time at the post office, dealing with some health issues. And let us just say that she didn't just merely dislike her job. She absolutely hated it. So after hearing all these stories, I finally understand now why sometimes people go postal. But she had no debt. We've done a very good job growing her IRA. So let us just say, let's just see if she can retire. As I said to her, let's see if this will happen for her.
Like many people, Sally was nervous about shifting from earning a paycheck to living off her savings. Even with a small pension, she was worried, as many do worry, about running out of money before running out of retirement. Most people won't say it out loud, but that fear is real.
And that's where the Envision process came in for her, which is a detailed retirement plan for her, for Sally. It factored in taxes, inflation, real-world spending, daily life, those projections in today's dollars, and then after tax. It didn't cost her anything, but it did require her time. It required her to be honest, and that's all you guys are really asking.
Right. And the result for Sally, based upon her pension, Social Security, her IRA that we managed, the plan that we could kind of put together, the odds of her retiring is very, very good, okay? How long did it take her to make a decision? Like 3.2 seconds. She's out of the post office.
I'm out.
She's gone. She's history. And to say she was happy, massive understatement. I've never seen anybody who was so looking forward to retiring. It was amazing.
So Sally's been living the retirement she dreamed of. Her pension and her Social Security are steady. We withdraw from her IRA monthly, withholding taxes and direct depositing the rest into her checking account. And if she needs extra for something unexpected, which, by the way, I just got a text message from my mom telling me that the Kirkland's next to the mall is apparently going out of business, so Sally might need some extra funds this month.
Uh-oh.
I know, it's so sad. I'm over here just like hardly even able to go on with this radio show. Everything's 30% off, Susan, if you need to.
It's on the way home, babe.
Kirkland's.
On your way home, go to Kirkland's.
Sounds like we're going to Kirkland's.
But anyways, when unexpected things happen like this, she calls us and we get it to her in just a few days. It doesn't take long. Her house is paid off. She's frugal. And despite regular withdrawals, her IRA has actually grown in value.
Helping people like Sally retire with confidence. That's the fun part of what we do. It's not just about numbers. It's about giving people the freedom to live the life they want without fear. And that's what organizing your retirement looked like for Sally. Remember, we are here to help, not judge. And the first step is to have a chat. And there's no cost or obligation for that.
And when we come back, y'all, we're going to give you even more reasons why you ought to have a chat with us. Stay tuned for more of the Fun Fest. It's East Tennessee's Financial 4 right here. It's the Organized Investor Show on News Talk 98.7.
Rising high above downtown Knoxville, one landmark shines brighter than the rest, the Sun Sphere. Since 1982, this golden symbol of the World's Fair has defined our skyline. And now, it defines how Knoxville celebrates. Sunsphere Events invites you to host your next gathering inside Knoxville's most iconic event venue. 2 breathtaking floors of panoramic views set the stage for unforgettable weddings, corporate receptions, and milestone celebrations, all framed by the glow of East Tennessee. From intimate dinners to grand galas, Sunsphere Events delivers an experience as elevated as its view. And with trusted local partners, including the culinary team from Rosa's Catering, celebrating over 50 years in East Tennessee, your event is in expert hands. Plan your next celebration today at sunsphereevents.com. Sunsphere Events, Knoxville's most iconic event venue. Erik Ainge is a host of The Erik Ainge Show on 99.1 The Sports Animal, weekdays from 9 to noon. He is not a client of Tennessee Wealth Management, but is compensated to both promote and co-host the Organized Investor Show.
All right, we're back right here on the Organized Investor Show, brought to you by Tennessee Wealth Management. If you're just joining us or if you've been with us, it's me, Ainge, from the Erik Ainge Show. Got creative with the name there on the Sports Animal, former Tennessee quarterback, or now known mainly as Susan's husband or TD's dad. I get that a lot, especially on campus. Right here on the station, it's the 4 of us. That's what we're doing. East Tennessee's Financial 4, and it's creative, but there's 4 of us, and we talk about your investments, your retirement, and your affairs. Jerry Goodman. Jerry's with us. He's a certified financial planner with more than 43 years of experience. He's been a vice president at Merrill Lynch for 17 years. We also have Megan Hubbard. She has a master's degree in curriculum and instruction, was a first grade teacher at CAK. She does great things about helping us understand these complicated issues and keeping it simple for all of us. And backed by popular demand, my beautiful wife, Susan Ainge, part of the gang, part of us right here at Tennessee Wealth Management, going to join us as well. And her contribution, her first one, like I said, was giving us that name, y'all, East Tennessee's Financial 4. The crowd goes wild.
It was late. So, as Erik so eloquently mentioned, we are offering to help organize your investments, your retirement, and your affairs. And to get your attention, we have something even better than buy one, get one. We have what we call get one free, get one free, get one free, and you guessed it, get one free.
Megan, did you say get one free?
I did say get one free. And if you weren't counting, that's 4 get one frees, and you don't have to buy anything to get anything free.
Thank you. And let me go back to what Erik said when he introduced me as Merrill Lynch. Some pieces of useless trivia is the Merrill Lynch Bull. In case you're wondering, his name is Lightning. Okay, that'll come in very handy at your next cocktail party. So thank you, Megan. And let me add about the 4 free get one frees, or the 4 get one free. Yeah, whatever that is. No strings attached. The first one is to help you organize your investments. And we're offering to give you a Morningstar summary report that we're going to create on your investments. Usually runs about 100 pages, sometimes bigger, based on how many pages we choose to print. And we'll also even toss in an English translation explanation of all that because it can be rather deep and thick. And if you want to know basically how much you're being overcharged in terms of advisory fees and mutual fund cost, it's going to answer all of those questions.
If you're curious if your investment performance is meteoric or just mediocre, you'll find out and they'll help you know. You'll understand just how much room there is for improvement in your long-term financial future. And if you're interested, there's a sample of all this right there on the investments page on the website, theorganizedinvestor.com.
Second, if you need help organizing your retirement, we'll give you a retirement cash flow analysis. This is called Envision, and there's also a sample on the retirement page of our website. Third, if you're one of many who has been ignoring your estate planning documents, it's your lucky day because we're offering to help you get all of that in one place. We purchased a number of estate planning packages from an online provider called Trust and Will so we could give them to our clients free of charge.
And since you're brave enough to listen into us, we are offering them to you as well. And to be clear, we're going to have a chat either by phone or in person to get this process started. Now, if you decide to use a will package of documents, this will probably be completely free of charge. And I say probably because if you prefer a revocable living trust, and that's your choice, you will possibly have a cost of just, retitling your property into the name of that trust. There is a cost associated with that. Now, either way, we'll help you to finally get your affairs in order and at little, if any, cost.
And fourth, to help organize and expand your Tennessee collection, we are giving you a full-size Tennessee football signed by my husband, Erik Ainge, complete with a stand, so it doesn't roll off the shelf and break something.
Not to be confused with a half-size football.
Full size.
So those are the 4 get ones. No cost, no obligation, no fear, whatever that means.
Yep.
Easiest way to get started, guys, with the Get One Freeze is either to call or text Jerry at 865-405-2070, 405-2070. And this actually rings to his cell phone. And you have to admit, if you're brave enough to do this, guys, really, it's not that. And Jerry's not scary, I promise. We'll tell you. You can email him if you want. It's all right there on the website, theorganizedinvestor.com. I say call Jerry, 405-2070.
So how about we spend a little more time harping on how this Morningstar summary is actually going to help you? And for starters, it may actually improve your long-term financial future and maybe by a lot. So what do we mean when we say a lot? Well, if our goal is an overall improvement of 2% per year or more, and if someone has $1 million portfolio, folks, that's $20,000 a year. That's $400,000 over a 20-year period. So basically, I would hope most people would think that's a lot, and that is on top of what you've already earning from the portfolio itself.
I would consider that a lot for sure. So we made up this entire 2% goal just to prove the point that even a small improvement over time can dramatically change your financial future. Now, to help validate just how true this is, Erik's a former quarterback, which means he knows how to handle pressure, right? Would you agree with that, Ian?
Bring it.
Okay, so you got to call the right play and, yes, even explain this team's track record without fumbling. So let's see him do this. Take it away, quarterback.
Omaha. Mike's 42, blue 42, green 80, set. Hut. Here it goes. In the first 9 months of 2025, the 210 managed accounts had an average net rate of return of 33.2%. That's over 3.5 times the Dow's return. Over the past year, 29.8%. Over 3 years, 22.3% annually. Over 5 years, 18.3% per year. That's more than 7 points higher. You just can't beat it. Green 49. Dive left, give me 6.
What did you say that the term was for?
It's like 6 or 7 points higher than the Dow. 7 points.
And what was the term you said the Jets when it was to hurry up? That was race car or
NASCAR.
Okay.
Do you want to play call? Sexy, Jack Right Zip, Act 4 Cobra, Dover, F Shoot, Hob, Hard 2, Ready Break.
That's easy for you to say.
And here are the boring parts from the new kid on the block. Past performance is no guarantee of future results, and that the returns may vary from account to account based on the investment objectives and tolerance for risk of each investor. There's a 10-page summary on our website with the entire track record. So now you have something to compare it with your own performance to see if it's, again, meteoric or mediocre.
Oh my goodness, these made-up words, they're killing me.
I'm jealous. I'm going to get in on this next week.
Well, if you're actually in the mediocre category, maybe it's time to ask some questions.
By the way, Maggie, that's different than mediocre.
another made-up word. Okay.
Well, no, it's okra Winfrey, but it's like the fried vegetable, the southern vegetable, okra.
Okay, I'm just going to keep going. If your returns are significantly lower, it doesn't mean you have failed, okay? So a softer, kinder way to phrase this is that you may have massive room for improvement. And in other words, maybe it's time to rethink what you're doing with your investments.
Once again, folks, that is where the Morningstar summary that we're offering to prepare and give to you can help so much. So when you consider we're offering to help you with, put some light on your situation without any cost or obligation, what's the excuse to stay in the dark, folks? This is, and that's not a rhetorical question. It's an honest question, an honest answer to the question kind of a question. Why would you not want to educate yourself just a little bit, particularly if it might improve your long-term financial future, let you retire earlier, buy a bigger car, buy a bigger house, leave more money to your kids?
There was a question mark at the end of that one as he sits next to Megan. So the 2% improvement usually comes from three things, guys: lower fees, lower costs, and better performance. In terms of lower advisory fees, many advisors charge an advisory fee that's probably about 0.4% higher than what you guys are going to charge. And that doesn't seem like a lot, but on $1 million account, it's $2,500 a year. It's $50,000 over 20 years in terms of avoiding costs. Many advisors put clients into 15 to 20, either mutual funds, exchange traded funds, alternatives, maybe annuities, and they'll have so many internal costs just buried inside of them, sometimes 1% or more. These guys right here in front of me, these guys are trying to avoid those different funds and process to hope save you about that 1% or more from those fees and costs, saving you money.
We try to improve investment performance for at least another % of improvement by being more selective with where we invest the money. If your advisor has you in 15 to 20 funds, each owning hundreds of stocks, you may be invested in thousands of companies. That means you effectively own about every stock on the planet, which doesn't just make you overly diversified. Mathematically, it makes your return average.
So you know what we like to call that? Diversification. And it can lead to mediocre returns, which we like to refer to as diversive performance.
Excellent.
You know us. We are obviously known for creating our own vocabulary, apparently.
Good delivery.
We like making up our own words. So owning thousands of companies means you own the good ones, but you also own a lot of the not so good ones.
What's really irritating is when you see an advisor who's charging someone an advisory fee, and what do? They go invest all the client's money in this cookie cutter bunch of 15 or 20 mutual funds that collectively own probably thousands of companies. And as we just said, funds usually have these internal costs buried inside of these things. And in some cases, there's another whole layer of management involved in this whole thing. So what happens? They end up high fees, mediocre returns. And again, it's what we call diversive performance, my favorite term of the day. Some advisors will actually delegate the selection of those mutual funds to somebody else inside their company, which brings up, again, this question: what's the advisor actually doing to justify even charging a fee? They're not even making the investment decisions for a lot of these types of accounts.
But so you go on the investments page on the website and you can see an example of a mutual fund advisory account with a 5-year track record. It's less than 9%. And you assume that advisory fee, once that's deducted, it's even less. As a reminder, their 5-year track record is over 18%. It's more than double that. For all of you out there paying an advisory fee, so you can own 15 to 20 mutual funds or maybe exchange traded funds, you end up with that mediocre performance. And at what point is that going to actually bother you enough? Again, rhetorical question, but pick the phone up.
So we obviously don't use mutual funds and exchange traded funds. We don't care much for annuities and alternative investments either. So how are we consistently getting these kinds of returns for our clients? Well, the simple answer is we invest in individual common stocks. There are no internal costs, they're more transparent, and they give you greater control over your taxes. And when we talk about common stocks, we use 2 different strategies.
So here we go. The first strategy, it's called dividend growth, and this is our core holding where we invest in companies with a history of consistently raising dividends. Now, perhaps you've heard of a few of these, okay? I'm pretty certain I've been in some of these this week. Costco, Walmart, Home Depot, Lowe's, Smucker's Jelly, Becton Dickinson, and General Dynamics. And some have actually raised their dividends every year for over 60 years. Many of these companies are on a research list by Wells Fargo called the Diversified Stock Income Plan, or DSIP for short.
This DSIP list, has a 30-year track record, 12% over this 30-year period, which is even higher than the S&P 500 index over that same period. And as one would expect, as we constantly say, more information about the DSIP list on the, folks, investments page of the website, theorganizedinvestor.com. Investors basically view these types of companies as being very well managed because they can raise their dividends just year after year after year. And it means that they're not going to be likely to sell them if you get into a market downturn. And so if they don't drop in much in price, during that kind of decline, it's very, very helpful when it comes to our next approach, which Erik's going to explain is called bargain opportunities.
Yep, that's the second strategy. I love this. Bargain opportunities. It's when you're going to take advantage of the temporary market overreaction, like COVID in 2020, banking crisis in 23, tariff scare in 2025. During these past opportunities, moving money from the companies that didn't drop much in price to the ones that did. And when things get back to normal, they either migrate back to our core holdings or maybe a money market fund.
So instead of owning thousands of stocks in a mutual fund, we're handpicking the ones that have proven themselves over decades. And if and when the market panics, we like to swoop in and buy quality companies on sale. This may seem so obvious, but basically we don't want to own everything on the planet. We want to own the best. And when opportunities come along, we love to swoop in and buy things.
We've done more than our fair share of swooping in to buy things. On a single day this past spring, we swooped in and made over 12,500 trades, which is one reason why our clients are up, on average, over 33% for the first 9 months of the year. We swooped in during COVID back in 2020 and the bank crisis in 2023, which is why our 5-year track record is over 18%, both of which are substantially higher than the Dow Jones average.
And again, we do have two approaches. The dividend growth strategy and bargain opportunities. And if someone wants to just be, again, invested in one of those two, that's fine. If they want to also participate in bargain opportunity, that's fine. Just let us know.
Every time we say swoop, I just keep thinking of the TLC song. Shoop. Doop-a-doop, shoop-a-doop-a-doop-a-doop. That's all I can think of when we say swoop.
Never heard of it.
You have heard that song, surely.
That does not surprise me.
True.
You're not a big TLC Waterfalls guy, Jerry?
No. I'm more of a Baywatch guy. Just turn the volume down and watch the pictures.
We'll play it on the car ride home. All right, so the Get One Frees. These relate to your investments, your retirement, and your affairs. And the Morningstar summary for your investments, the cash flow analysis for your retirement, and the estate planning documents for your affairs. And don't forget the autographed football. And to get started, we need to start a conversation with you.
It's really sad when someone actually realizes, hey, their returns are a lot lower than what our clients have been experiencing. And guess what? They still don't do anything. They just sit there. So if you're concerned that you don't know us, consider this. We have 650 accounts spread over 240 different families. At some point in time, none of these 240 families knew us either, but they know us now. And some of these have been our clients and turned into friends even for over 40 years.
And if having a meeting with someone puts you in panic mode, here's a baby step idea. Call Jerry for what he calls Ask Anything in 20 Minutes phone chat. His number is 865.
Wait a minute, what is it? What's the area code?
865.
Oh, I thought it was Vol.
Vol. His number is 865-415-2070. Yes, it actually rings straight to his cell phone, and I promise he'll be nice to you. If he's not, just hang up on him. Plus, the best part, it's free.
Now, the fact that they're offering to help you with all this, guys, for little if any cost may seem pretty incredible, but Jerry's the do a good deed daily guy, right? That motto from his time with the Boy Scouts. So take the opportunity. I'm telling you, give him a call, 865-415-2070. You can ask him anything in 20 minutes. No cost, no obligation. It's a good use of your time right here. So is listening to East Tennessee's Financial 4. I'm Erik Ainge, alongside Megan Hubbard, my beautiful wife, Susan Ainge, and Jerry, Megan's dad, Jerry Goodman, right here. It's the Organized Investor Show. More reasons for you to listen when we come back right here on News Talk 98.7.
At the Grimes Agency with Goosehead Insurance, everything starts with one goal: putting clients first. The team is committed to adding value, providing clarity, and ensuring every client feels confident in their coverage and price. As a true brokerage, the Grimes Agency shops your insurance with over 30 A-rated companies, including Progressive, Farmers, Travelers, Nationwide, Liberty Mutual, and many more, so we can make sure you have great coverage at the most competitive rate. From home, auto, umbrella, and dwelling to life and jewelry insurance, they offer personalized protection for what matters most. With honesty, transparency, and a client-first approach, this is insurance the way you always wished it was done. Call Mike Grimes at 865-281-1267 or visit www.tn.insure to compare real quotes in minutes. The Grimes Agency with Goosehead. Insurance the way you always wished it was done.
Erik Ainge is a host of The Erik Ainge Show on 99.1 The Sports Animal, weekdays from 9 to noon. He is not a client of Tennessee Wealth Management, but is compensated to both promote and co-host the Organized Investor Show.
Welcome back, guys. It's the Organized Investor Show, brought to you by Tennessee Wealth Management. 4 of us in the studio, and our goal is to help you organize your investments, your retirement, and your affairs. My wife, Susan, suggested it, and it's stuck. East Tennessee's Financial 4. I'm Ainge. You know me from the Sports Animal for my show. And the other 4 of us here on the team with Tennessee Wealth Management. Start with Megan Hubbard, master's degree in curriculum and instruction. Used to be a teacher at CAK. She's the dean of our college knowledge here. Susan Ainge, she is a new member right here with Tennessee Wealth Management and the Organized Investor Show, keeping us all in line today. And she'll be wearing a number of hats, and one of which is to balance it out in here so it's not me and Jerry versus Megan. It's me and Jerry versus Megan and Susan. Right here.
Guys against girls.
I feel like they're going to beat us, Jerry. I'm just going to throw that out there. And Jerry, you always hear me talk about Jerry. That's Jerry Goodman, Megan's dad. He is a CFP with 43 years of experience, formerly vice president at Merrill Lynch, and a bunch of other fun facts. He enjoys long walks on the beach and inappropriate jokes.
Yes.
That he does enjoy inappropriate
Someone's got to
jokes.
tell them, folks.
And he is definitely not a CPA. He leaves that to my husband, who is also an advisor with us.
But
But
he's a
our tax
CPA.
department. He is a CPA. So we defer all of our tax questions to him. So if you're just joining us, we've been talking about how we may be able to help you organize a lot of different things. And it's always possible to miss something big. These are called blind spots. And yes, I have a blind spot monitor on my car. So luckily, I don't hit many things. But we're here to be that monitor for your investments, for your retirement, and for your affairs. And in terms of your investments, most people don't know how much money they have invested. They don't know what it's invested in. They don't even know about the performance. So maybe they know they've contributed something and maybe the current balance, but they don't typically know their returns. It's like playing a football game and not paying attention to the score. How stupid is that?
Football analogy, Megan gets the point. The next blind spot, retirement. People may wonder, do I have enough money to retire? But very few people actually have any kind of actual plan, if you will, to factor in these fun little things like taxes, inflation, and how much they may actually spend. So, most of the people won't even admit out loud anyway that they are more worried about running out of money than they are about dying. Kind of scary, but that's I can see where that would be the case.
And the third blind spot involves their affairs. And I'm not talking about the extramarital kind. Estate planning is the most overlooked part of financial life. You may think you're covered, but when these blind spots collide with real life, the results are devastating.
So we've been discussing how to fix these blind spots simply, clearly, at no cost. And instead of doing the buy one, get one opportunity thing, what we're talking about right here today, guys, is just 4 get ones. Get one free, get one free, get one free, get one free. They're not going to charge you for any of these 4 get one frees. That's why they're free. However, you do have to invest a little time, a phone call, maybe come by the office face to face.
For organizing your investments, we'll prepare a Morningstar report on your investments, usually over 100 pages, and we're also going to give you a clear, plain English explanation of what it means. You'll realize just how much you might save on advisory fees and mutual fund costs, and how much we may be able to improve your performance and long-term financial future. There's a sample on the, you guessed it, investments page of our website, along with many other things to look at.
And that web address is theorganizedinvestor.com. Now, for organizing your retirement, which is one of the second get one frees, if you need it, some people don't, but if you feel you do, we'll give you a retirement cash flow analysis along with this. There's also a sample of this on our website. We'll explain to you exactly how that goes. That takes a little time, but if you want to, we'll be happy to walk you through that. For organizing your affairs, we can actually help you get your estate planning documents in place through our partnership that we have with an online company. It's called Trust and Will. Now, to explain why are we doing this, how are we doing this, We bought a big pack of these estate planning packages. We bought them to literally give away to our clients who haven't gotten around to doing some of this. It happens to all of us. We give it away to them at no cost, and we're making this offer to you as well for free. Now, if you decide you want to use just the will package of documents, which is fine, that's completely up to you, and that's completely free of charge. If you'd prefer to use a revocable living trust, the only cost is going to be the cost to retitle your property into that trust that you're wanting to set up. So either way will help you finally get the affairs in order, and it's going to be at very little, if any, cost.
And the fourth thing they're offering to you is a full-size Tennessee football signed by the quarterback of our show, Erik Ainge.
That's me, guys.
Plus, we even have an orange tea to keep it from rolling off the shelf.
Hey, and rumor has it you're going to be signing it too, Susan?
And TD.
And TD, okay, 3 signatures.
And scribble on it.
Yeah, that's right.
Usually we do it for
if he
cards.
becomes a quarterback one day, that will be very
That's what.
valuable.
When he becomes.
Yes.
Yeah, but Dad wants him to play baseball.
Baseball, too.
Well, you got to let him do what he wants to do, right? All right. So, how's a Morningstar summary going to help you? Well, for starters, it may improve your long-term financial future because it's going to educate you about the excessive fees and costs that you're paying and about the mediocre, or one of those other made-up words my dad had, about the mediocre performance that you've actually been getting probably for years. And we've been explaining this for years, that improving someone's overall performance by just 2% or more would materially improve their long-term financial future. Now, for $1 million portfolio, that's $20,000 per year, or $400,000 over 20 years. Is that enough money to get your attention?
I hope so. That seems like a chunk of change. So let's explain just how important it is to focus on the fees, the cost, the performance. Erik, with a K, basically he's traded in his helmet for a new headset. His playbook is still sharp, and he's about to break down our client performance like a 2-minute drill. Fast, focused, full of wins. Hit it, Dr. Ainge.
For some reason, I feel like I'm going to start yelling this like I'm in a huddle or something, or there's 100,000 people. I shouldn't do that. I'm just talking into a microphone. In the first 9 months of 2025, the 210 managed accounts they manage average a net rate of return of 33.2%, over 3.5 times the Dow's return in that time period. Over the past year, it's 29.8%. Over 3 years, 22.3%. Over 5 years, 18.3%. And over nearly 7 years, 17.1% annually. And that, again, tops the Dow by 7+ points.
Here comes the really interesting part. Past performance is no guarantee of future results, and that the returns may vary from account to account based on the investment objectives and tolerance for risk of each investor. And if you happen to actually know what your own performance has been, you now have our track record to compare it to.
The blind spot for most people is that they don't know how their money is being managed or what their actual performance has been. That blind spot is even worse when someone's in the third or fourth quarter of building their retirement nest egg and they don't even know what's on the scoreboard. That is where the Morningstar summary can come in handy for you.
So the 2% improvement usually comes from 3 things. You've been hearing us say this, guys, but it's important. Lower fees, lower costs, better performance. Lower fees, lower costs, better performance. In terms of lower advisory fees, many advisors charge an advisory fee that's probably about 0.25%, if you will, higher than what Tennessee Wealth Management's going to charge. It may not seem like a lot, but on $1 million account, that's $2,500 a year. That's $50,000 over 20 years. When you look at avoiding costs, many advisors are going to put people into 15 or 20 mutual funds, ETFs, alternatives, maybe annuities, and they have a lot of internal costs buried inside of them, sometimes a full % or more. And avoiding all of that is how they're going to save you money.
So too much diversification leads to what, guys?
Diversification.
Which results, we're getting kind of good at this, which results in a new term of the day, which is
Diversive performance.
Goodness, you finally can say it. So in other words, mediocre returns, folks. And having thousands of investments means, sure, you own some of the good companies, but you also own a lot of the not so good ones. Who wants to own those? So instead of mutual funds, ETFs, all those sorts of things, we basically focus on individual common stocks that there are no hidden internal costs. They're much more transparent. You know exactly what you own, and there's much better control over your taxes, which is a really big deal. So when it comes to common stocks, we basically have 2 simple ways that we manage these.
So let me go over the first one. It's our core holdings, which are companies with a long history of raising their dividends. These are companies like Costco, Walmart, Home Depot, Lowe's Home Improvement, General Dynamics, and even Smucker's Jelly, our favorite jelly. Some of the companies like Lowe's, for example, have raised their dividend for over 60 years. These types of companies are from the Wells Fargo Diversified Stock Income Plan that we refer to as the DSIP list for short.
And this list has a 30-year track record of over 12% per year. And there's more information about the DSIP list on our website, theorganizedinvestor.com. Because investors view these types of companies as being well managed, their price holds up better during market downturns. So these dividend growth stocks are our core holdings that we use as our starting point and our core strategy.
For the second approach, bargain opportunities. And whenever the market overreacts, like during COVID, 2020, banking crisis, 2023, the tariff scare, spring of 25, we like to swoop in and buy a lot of these quality companies when they're on sale. In the spring of 25, you guys did 12,500 trades in a single day, which is why your clients have a 33% net rate of return for the first 9 months of the year.
It was a busy day.
Probably a fun day. Also, you look at swooping in during COVID, the banking crisis as well, and that's why the 5-year track record is over 18% per year.
The fact these type of dividend growth stocks are less volatile, what does that mean? It means you can move money from things that have not dropped much in price when you do get a market drop into things that have gone down a lot. Doesn't seem like a big deal, but it really can be. Now, if someone just wants to be invested in, say, the dividend growth strategy, the core approach, that's fine. If they want to also participate in the bargain opportunities when those occur, we'll help them do that as well.
So we focus on common stocks and we try to avoid mutual funds, exchange-traded funds, and any number of things that have hidden fees and are suffering from diversification, which leads to performance. It's actually going from insult to injury when someone's paying an advisory fee and only to be placed in 15 to 20 mutual funds that collectively own thousands of companies. And the result? Well, it's higher fees and mediocre returns. So it's fair to ask, what exactly is the advisor even doing to justify charging that fee?
And you guys, it's posted right there, mutual fund advisory account on the website, on the investment page of the website, theorganizedinvestor.com, and it's got the 5-year track record, and it's less than 9%. That's before the advisory fee was even deducted. So by comparison, 5-year track record from y'all, more than double. It's 18%, over 18%. If you're invested in one of these mutual fund advisory accounts, making like 8-9% return, it may not seem terrible, but when you compare it to your performance, it helps you understand what that truly mediocre return that you currently have is looking like.
So how is any of this going to help you? Well, actually, it won't if you don't do anything. The smartest thing you can do is have a chat with us. Just pick up the phone and call Jerry at Vol 415-2070.
Thank you.
Or go ahead and just send us an email.
And how about we change directions for just a second and let's harp on estate planning one more time. He's been helping people with estate planning for years, my dad has, and he even wrote The Widow's Digest about 25 years ago. And there's a copy on the affairs page on our website. If you really want, we can get you an autographed copy of that.
I'll sign the football, you sign the book.
Exactly. So in reference to estate plan, I'll tell you a little story. A few years ago, I was explaining to a group how we actually help people and we didn't get paid for it. So that's what this woman informed me in the group. She said, well, nobody works for free. I started to say, would you please sit down and shut up? And I thought, I'll be nice.
Be nice.
I know. It crossed my mind. So I said to her, look, I understand. I get it, okay? Sometimes we help people become clients, and sometimes they don't. That's okay. But since you brought it up, let me just tell you why we actually do this and why we don't charge for this, okay? Now, I figured this might actually make her feel bad about picking on me, but
probably not.
I know.
Badly.
I know, it crossed my mind. But I said, let's go all the way back Saturday, February 23rd, 2019. This is when I lost my Forerunner. It had rained like 9 straight days in a row. Some of you may remember this. That particular day, it dumped 5 extra inches on the road. 8 p.m., I'm driving home. Megan had warned me about the roads being flooded. Do I listen to her?
Nope.
I was driving alone, South Peters Road, when my car basically hit this flooded roadway. I was going 40 miles an hour, I guess. Water crashed over the hood. I started screaming a bunch of profanities, if you will.
I believe that.
It happens. Rolled down the window, climbed out the window, and within seconds, I'm standing on the side of the door, holding on the roof rack. Water's now up to my knees. The car is still sinking. I look back and I'm thinking, my gosh, I'm 250 feet from where I came in because I was going pretty fast. So situation dictates the policy. You have to call an audible. Basically, I jumped in, swam back at night, fully clothed, which was actually a lot harder than I was expecting. And obviously, I made it back, or otherwise I wouldn't be sitting here talking to you. I'm walking out of the water like a swamp monster, and all of a sudden, then I noticed the road closed sign, which the itty-bitty road closed sign, I'll say, that was sitting in the turn lane.
All right, so I'm going to chime in here because this really did happen. I was actually the one that came and picked him up. And of course, I yelled at him all the way home because I had already warned him about what was going on. My mom was at the beach. She had no idea. My sister, I'm calling her, trying to get her to come and help me with this situation. She's
Okay.
hanging up the phone.
Keep going. That's enough.
But the next morning, he did learn that, unfortunately, there were 2 more drivers that had gone into that same water. And one of them was Chris Duty, and he was a 59-year-old disabled Air Force veteran. He couldn't escape because he had his left leg amputated.
Oh, my gosh.
And so he actually did die that night, and his wife, Rebecca, was on the phone with him when it happened. So
That's
it actually
terrible.
was a very sad situation.
It was pretty upsetting. So I got in touch with his wife. It took me a couple of days because I wanted her to know what happened. Basically, the sign was like itty-bitty. It was kind of very easy to miss. The water was basically invisible at night. So a few days later, I'm now sitting on the back row of a funeral of somebody I've never met, and the moment literally changed my life. Seems kind of corny, but that's why I'm so passionate about trying to help people get organized, and that's why we try to remove some of the cost barrier, and why we're willing to help people take care of this, at little, if any, cost at all.
So, when you realize what happened to my dad, the fact is he's offering this to you for free. It's not a surprise to any of us. It's not a surprise to me. This has truly become a passion for him. And for years, he's had this do a good deed daily motto from being a Boy Scout. So you need to understand he's being perfectly honest here and serious about all of this. This is not some sort of a gimmick.
Well, I mean, that's good story, terrible story. Man, I hate that the gentleman passed, but it's good when something bad happens. You can't control that. You do something good with it, Jerry. That's pretty cool to hear. And it's not just that, guys. It's learning what to do for your investments, your affairs, your retirement, all of these things. And you can join us each week right here on the Organized Investor Show. It's East Tennessee's Financial 4, and you can keep hearing other reasons why you ought to call and have a chat. You can listen to our show on your favorite podcast player with a search of The Organized Investor. You can go to the podcast page of theorganizedinvestor.com right there on the website. Follow us on your favorite social media for updates about future shows. All right here. This is Ainge, again with my beautiful wife, Susan Ainge, Megan Hubbard, and Jerry Goodman from Tennessee Wealth Management. It's the Organized Investor Show. We'll see you next week.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of the Organized Investor or Tennessee Wealth Management. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional investing advice. Erik Ainge is a host of The Erik Ainge Show on 99.1 The Sports Animal, weekdays from 9 to noon. He is not a client of Tennessee Wealth Management, but is compensated to both promote and co-host the Organized Investor Show. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning or before making any investment decision. And please consult legal or tax professionals for specific information regarding your individual situation. Brokerage and advisory services are provided by Tennessee Wealth Management through Prospera Financial Services Incorporated. Member FINRA SIPC. The Organized Investor is a brand name operated by Tennessee Wealth Management for educational platform purposes.